This is Chapter 10, Video 1. Let's launch. So in today's lesson, we're going to describe the cost recovery methods for recovering costs of personal property, real property, intangible property, and natural resources. So first of all, if you guys haven't figured it out yet, cost recovery is another word for depreciation. So essentially what's going to happen is you're going to be purchasing assets throughout the life of the company. And then what's going to happen is you're going to have to capitalize it. Now, what happens after that is determined primarily based on what kind of an asset it is. And so that's kind of how that happens, and that's what we're going to be talking about in today's video. So businesses must capitalize cost of assets with a useful life of more than 1 year on the balance sheet rather than expense the cost immediately. There's a couple exceptions to that, but for the most part, that's kind of the way it is. You'll at least have to capitalize it and be able to write it off. Now, one of the exceptions they do have is that one of the logical ones is a de minimis. For example, if I buy a computer and I spend $300 on it, IRS isn't going to make you depreciate that over the time. So you want to make sure that you're following those rules and doing what you're supposed to with that. It's also known as depreciation, amortization, and depletion. Of course, what I said earlier, amortization and depletion is another way of doing this. Depending on the nature of the asset. So, for example, and it follows basically the same logic that you would see in financial accounting. So, obviously, if it's most fixed assets, it's going to be depreciation. If it's an intangible, most likely amortization. And then if it's a natural resource, it'll be a depletion. Business use of these assets to recover cost method due to wear, tear, and obsolescence of assets. Now, that's the whole theory behind it, but what you're going to notice when we start talking about this is that the IRS actually accelerates the depreciation. And part of the reason why they accelerate the depreciation is because of, for national reasons. And so what they want to do is encourage people to go out and buy new assets. And, in previous classes, I like to say depreciation is like a drug. Once you start getting hits, all of a sudden you're kind of addicted to it and you're looking for additional deductions. And this is one way that we kind of go to our clients and say, you're going to get a huge income hit this year. Why don't you go out and actually update some of the assets that you have for your business? And then maybe you can go ahead and you can get some of that stuff taken care of. So that's kind of the way this gets done and how it can be done. So different methods, like we said, depreciation is deducting the cost to tangible, personal, and real property over a period of time. Amortization is the cost of the amortization over a specific period of time. And then depletion is also deducting resources over time. Now, what's going to trigger some of this stuff? It depends on the asset itself. So again, time is going to be the most common, by far the most common. Depletion is probably going to be one where you may not necessarily be doing it over time. So for example, I got a piece of land. There's a whole bunch of trees all over it. I contact the USDA and I say, hey, I need you to go do an appraisal of this. They come out, they do an appraisal. They say, okay, the trees that you have are valued at this, or their depreciation base is this. And then as you start pulling trees, you're going to start counting trees and you're going to say, okay, this is going to be the depreciation value or depletion value that we're going to assign to that as it's been pulled. Basis for cost recovery. Okay, once use of the purchased asset is started, recouping the cost of assets is also started. Now, that line is kind of a little misleading. It doesn't always happen at purchase. It does happen at purchase and also once placed in service. So, for example, if you purchase a machine, we'll say you purchase a 7-year asset and you buy it and you bring it to your business on December 1. You've signed a contract that you're going to intend to do that, but you don't actually pay for it till the following year. Then what ends up happening is that you really haven't paid for this until that happens. And if you're a cash basis taxpayer, when cash changes hands, it's going to be a big deal. Now, if you buy the asset and it takes 2 months to bring it in, so maybe you buy it December 1, but it's not placed into service till the following year, you're going to put it into service and start depreciating it as of that time. And so that's really what you have to do. And you're going to have to do an assessment of that of every single asset that you purchase. Initial basis reduces reduces when cost is recovered through cost recovery deductions, which is called an assets adjusted basis or tax basis. And we kind of talk a little bit about this. This is one of the things I don't like about the online version versus the in-class version. I go through an entire example of this where we kind of talk about how we're going to do this over bigger, better things. But basically, when you start calculating your adjusted basis, it's going to be cost of the asset minus depreciation plus improvements, plus any other additional tax write-offs that hit basis. And we'll go over a couple of those throughout this class. And there's some other ones that we may not hit in class. So you need to make sure that you're actually looking that stuff up. The assets adjusted basis, again, they said that's the initial basis minus accumulated depreciation, amortization, or depletion. Again, say, for example, you buy a 7-year piece of machinery. We'll say that it has a compressor in it. The compressor breaks. You spend, $20,000 getting that, back working again. The IRS is going to come back to you and say, hey, you got to add that to the cost basis and depreciate it over time, because that's actually going to be, it's going to be instead of it being seen as a repair, it's probably going to be seen as something that increases the life of the asset. And ergo, you have to go ahead and depreciate that over time as opposed to taking immediate expense, unless it qualifies for an additional expenses under certain rules. All right, so this is, where they have, asset type, cost methods, and just some examples. I wanted to bring this up to you. And so, personal property is comprised of tangible assets such as automobiles, equipment, and machinery. Real property, all that stuff is going to be depreciated. Intangible assets, such as non-physical assets, goodwills, and patents. Remember, notice that goodwill. Okay, goodwill in the U.S. tax code is still amortized over a period of time, and it's actually amortized over 180 months or 15 years. And so what happens is you get some goodwill, you've got to amortize it. Now, what happens in financial accounting? We test it for impairment every single year, and based upon whether that impairment is determined or not, we may write down some of our goodwill. But that doesn't happen here. You amortize it over 15 years or 180 months. Actually, they do it by the month, so it's going to be 180 months. Okay. Natural resources are commodities that are considered valuable, such as oil, coal, timber, and gold. I actually had a client, actually my first year in accounting, I actually had this happen where a person who had inherited some farmland that, he didn't want to do anything with it. They got rid of the farm and planted a whole bunch of trees. And next thing you know, 30, 40 years later, the timber companies are coming to him saying, hey, you got a whole bunch of trees. Want us to cut some down? And we'd like to come down. We're going to pay you $30,000 for it. And he was like, yeah, sure. That sounds great to me. I mean, for him, it was not much of anything because, his father had actually done all the planting. But, they came in and they paid $30,000. And then in the future years, they did it for a couple other years also. So you can earn some money off of that. Okay, so that's all I got to say about this lesson at this time. Guys, keep trucking along. This is section 2. So hopefully we get to wrap this up, and then we get to move to section 3 and get to keep learning. I look forward to seeing you in class.